Take a look at what 2-year yields are doing, because we have seen the massive volatility in the bond space, right? I mean, surges and falls really all over the place. What is the bond market telling us right now, and who is correct when it comes to where yields are going, where the Fed is going, where the economy could go in the next year?
Yeah, obviously a good question. And remember, we're trying to be predictive in the bond market and the equity market, and one of them will be right. We just don't know which one. Clearly, the volatility in bond markets and equity markets in June, and the volatility in the correction the other way in the rally of risk assets in July, illustrates the concern and difficulty of trying to be predictive going forward with the quality of earnings in aggregate, the credit conditions, and what policy would do. So the reality is, I think when you look through it, if you look at like a bear inversion, so the yield curve where it is, from particularly the 210s, but at a much higher, add 50 basis points to it across the curve, inversion increasing slightly at an increasing rate as the Fed starts raising rates more aggressively through this cycle to address core inflation measures and concerns. But that's the reality, is trying to second guess how that's going to happen. So clearly, labour market data on Friday night means 75 basis points is really, there's nowhere else no alternative for the Fed given the language. So 75, and then we all know that the bond market is trying to be predictive on how those annual year-on-year CPI core measure basket. So outside of that, commodities on the sentiment are falling. We all get that. But the reality is, you know, the PCE, the deflators, etc. Right. It looks very difficult to get a 3% on it. That's the concern we have.
If we have more spending on the fiscal side of things, we have seen now the Senate Democrats passing that climate healthcare tax bill as well. Do you factor that in as extra spending now, or do you just price it in for the future? We have seen the likes of analysts talking about perhaps a boost for EV makers, perhaps more taxes for big tech giants. Do you think of those political angles to the markets right now?
Yeah, look, as the bill goes obviously to the House now, which we'll go through and cleverly done before the midterms, the way to look at it is there's a transition component to it, and it's good for certain sectors and certain companies in aggregate. And there is a bit of a tax aggregate impost from the claims that they have going forward. But the point is, higher rates are not conducive to risk assets until you can understand where the rates are going. And in aggregate, this obviously, you know, the act is very important, but it's a higher cost impost for the years ahead in aggregate, even though it's trying to address this very difficult transition, obviously for economies that will take many decades. But it's an additional cost for corporate America and other developed economies. Nevertheless, it's required, and that's why I'll be looking at it from an aggregate perspective, and it has to be done regardless.
George, you're still quite constructive when it comes to commodities and energy. Take a look at this chart and it shows exactly why, right? We've seen this run up and we've seen still so much positivity when it comes to earnings estimates for the mining stocks in the green there being the brightest. And when you take a look at earnings per share, they're actually sitting at a record for the miners. Given the ongoing environment, which is expecting to be gradually at least deflating, does the shine sort of wear off this trade a little bit?
Yeah, the shine's wearing off pretty much since March. That March quarter was very, very strong, those results coming through. I think going forward, being neutral, those sectors is important. Not that we don't think the capitulation trade for the next bout of volatility is the way to go, and we don't think going underweight this is the way to go, but neutral positions, depending where you are and how you position your portfolios, whether it's credit or at the bottom of the capital structure, equities. But there are concerns, obviously, as you're trying to slow the economy, and as central banks are trying to do that, and that weighs and obviously the shine on future earnings. But they've contributed a lot, obviously, to the earnings uplift and meeting expectations and beating them where required. It just means the materials and energy in general are going to continue to pump out a lot of cash, and that's a good dividend cushion to have with the uncertainty of what the correct valuation are for those going forward. Again, as central banks need to put the brake on harder to reinforce the point, the labour market data on Friday night just said that the Federal Reserve hasn't got that economy under control yet and needs an awful lot of tightening ahead, and therefore puts strain towards what is the correct valuation 1 year forward. But materials and energy, neutral positions seem reasonable. And again, when the next bout of volatility happens, which it will, no capitulation trade, that's not the way to go.
Consumer discretionary in Australia on track for the worst year since 2011. How correlated is this when it comes to the ongoing weakness that we're starting to see across the property space?
Yeah, obviously high correlations, as they say. The Australian market, obviously, with the cash rates, high correlation to mortgages, high correlation to discretionary spending. Look, reinforcing, I'm not here to reinforce what the RBA says, but that $250 billion cushion for households through this pandemic, coming out of it, they're going to take a lot of that back. There's a lot of concern, obviously, with sentiment, consumer sentiment at recessionary levels, business sentiment not quite so. But conditions, labour market's tight, there is cash in aggregate on people's balance sheets. They've been prepaying their mortgages over the past 5 and 10 years. It's the new mortgages of the last year or so that will be in strain going forward, and low impairment. So that's going to make that will persist with us for some time. There's still a lot of cash on balance sheet at the household level. It's just the sentiment's not there. Cheap valuations, of course, but I can't see that repairing itself in a hurry with higher rates yet to come in Australia.